Good morning. Why retail absorption is tied to rooftops. And if you understand one principle in retail commercial real estate, make it this: retail doesn't lead growth, it follows rooftops. So, for investors, developers, and business owners in Houston, in Katy, in Fulshear, this is the difference between owning a fully leased strip center or sitting on vacancy for many years. So, let's break it down for you. Well, what is retail absorption? And retail absorption refers to the net amount of retail space that gets leased over a certain period of time. So, how much market is absorbing. And positive absorption equals demand is strong, whereas negative absorption means oversupply or weak demand is the prevailing wind. But here's the key: retail demand is not created by retail itself, it's created by people. So rooftops are the demand drivers for retail. And in commercial real estate, rooftop simply means population growth as well as residential density. And more rooftops equals more consumers, more daily traffic, more spending power, and more service demand. And that's why retail follows housing and not the other way around. So let's look at a Houston case study, particularly with a focus on Katy and Fulshear. So take a look at what's happening here. In Fulshear and Katy, in West Houston, there's a lot of master plan communities like Cinco Ranch, Ellison, Jordan Ranch, excuse me, and Cross Creek Ranch are exploding. Thousands of new homes are delivered annually, and population growth is just outpacing infrastructure right now. And what is the result of that? Well, retail developers are racing to keep up. You're seeing new shopping centers everywhere. There's the Texas Heritage Parkway Marketplace coming soon. There's new strip centers along FM 1463. There's retail pads near Grand Parkway and I 10. There's medical QSR and service retail filling gaps. So the retail development formulas, and developers don't guess, they're really following a formula. So the rooftop threshold is typically 2,500 to 5,000 homes within a 3 mile radius is going to equal traffic counts of 15,000 to 30,000 per day. They want to look for income levels that have a higher disposable income, which is a stronger retail tenant mix driver. But also growth velocity. It's not just population, but how fast it's growing it over time. And if all of those align, retail absorption will follow. So why some retail deals still fail? And here's where investors can get burned. They've built retail before the rooftops were there, overtime the market. And some common mistakes may be that overestimating the population growth timing, but ignoring the pace of absorption in the market. So build when there's too much inventory, or if there's building too much square footage too early as well. That's another possible constraint. But you need to look at your vacancy projections, rent concessions that you'll have to give out, and lower NOI equals a lower valuation. So the investor insight is that timing beats location. And everyone says location, location, location. But that's incomplete. The real rule is location plus timing equals profit. And if you enter too early, you're going to carry the deal. And if you enter too late, you're going to overpay on the deal. So the sweet spot, be Goldilocks. When rooftops are committed, but retail supply is still catching up, it's a great time. So, what this means for CRE investors. And if you're evaluating a retail deal in Houston, you should ask yourself these questions: how many rooftops exist today versus projected in 1, 3, 5 mile clusters? What are the lease rates for nearby centers? Are tenants already pre leasing space? Is there a lot of vacant space? Is there infrastructure, roads, schools, and hospitals in place? So retail is a reactionary asset class, and it performs best when demand is already proven. So why institutional capital is paying attention there? And institutional investors are targeting suburban retail, again, because migration to the suburbs is accelerating, and hybrid work supports local spending, but also service-based retail like medical, food, fitness. Those are resilient asset class or resilient markets right now. And Houston, especially West Houston, is a prime example of all of that. So the final takeaway for the day is that retail follows rooftops, always. And retail success is predictable when you understand population growth and the timing of it, the demand density. And the best deals aren't found. They're identified early when rooftops are still going next. So here's the call to action for the day. Are you looking at a retail opportunity in Katy, Fulshear, or Houston? Let's break down the numbers together and talk a little bit more. My name is Bill Rapp. Please visit my website, HoustonRealEstateBrokerage.com. You can figure out how to get a hold of me, and I'd love to have a conversation.